Afternoon, guys. Millies of Fogozi here from Just Capital. Today I'll be reacting to the inflation numbers that just came out today. As we all know, today was a CPI data release, and this was the last release before the next FOMC meeting, which comes on the 1st of November. An important CPI report that is given the fact that the Fed has become a data-driven institution, and they've recently told us that their signals are flashing that inflation has come down, and that was not the case today. Even though the numbers that came in were a bit mixed, with core CPI coming in softer than expected or coming in right on expectations, whilst headline CPI came in hotter than expected. The monthly CPI numbers coming in hot also led to the yearly CPI numbers coming in hot. We now find ourselves in a situation where inflation is accelerating again. So the miss in the report was quite a minor one, but the market had a strong negative reaction because this could push up the probability of inflation remaining stubborn. With inflation remaining stubborn, this might prompt the Federal Reserve to continue with their hiking cycle, keeping rates higher for longer. In fact, the projections for the Fed to cut rates have lowered since the release of the inflation numbers, and the probability that they will continue to raise rates in the next FOMC meeting went up by 3.5% in the 10 minutes after the CPI was released, and that probability is likely to continue as we approach the next FOMC meeting. So, what does this mean for us in our portfolios? For me personally, I went into this CPI report having bought the dip in the US 100. As you can see here, I bought the dip after I saw this doji here. I really like the simple technical analysis, and I like using a daily chart as my chart of preference for entering into new positions and all of that. So as you can see here, as I have said, I went into the CPI report having a long position in the Nasdaq 100 with my stops already in profits. But I was humbled after the the release of the CPI, and I then just decided I need to change my bias on this one and go short. Why did I want to go short? Because sticky inflation is usually a bad catalyst for stocks. Once you have sticky inflation, that means interest rates might continue going up. It means the Federal Reserve might continue tightening, and tightening is usually not good, especially for technology stocks like the Nasdaq 100. They are in fact very sensitive to high interest rates, so that's a bad catalyst for them. That's why I'm positioning myself to go short the Nasdaq 100. But I'm not going to go out there and just bet my whole house on the Nasdaq 100. No, what I'm going to do is I'm going to start placing small incremental short positions as the trade moves into my favor, and as it moves deeper into my favor, then we'll start leveraging very hard. I'm also short the German index, German 30. I'm also short that with good profits over there. Another chart that I like that I'd like us to react to is gold today. I also went into gold with a long bias, actually a couple of long trades, having seen that this gap here was left unattended. uh, I loaded into some long trades the day before yesterday, but I was humbled when I saw that the gold couldn't make it above the 1886 area. In fact, when it broke below 1880, I put a sell position right below 1880. as a psychological level. I had 1880 as a psychological level in my head. Good profits right there that we've made so far on the day. I don't have a clear bias on gold long term. I'm bullish, but at the current moment, I have short positions. Um, and the plan is similar over here. Small starter positions. As the trade moves deeper into profits, I'd like to look to add and leverage as it moves further into um, my take profit. So in conclusion, guys, CPI numbers came out today just to tell us to buckle up. The bumpy ride ain't over yet. If you can, you'd like to buy US dollars as your safe haven vehicle, your short equities, and yes, that's it. I'd like to keep end there for today. My first